Hi, my name's James Johnson. I've been a wealth advisor since 2003, and my specialty lies in retirement and estate planning. And today I want to talk to you a little bit about the power of indexing. And I think it's important to understand that when we're talking about indexing, we're not talking about an index fund. We're talking about how we use indexing with insurance products, and we follow our most important rule. And we think it's most important to avoid the losses rather than pick the winners. See, everybody's always out trying to get that really, really high rate of return on the chance that they're going to lose a lot of money, when in fact they could actually go out and get reasonable rates of return and never lose money. And one of the golden rules of investing is to never lose money and buy low and sell high. So as we approach retirement, what happens here is that we're going to have a few issues that could have a huge impact on our retirement. And one of them is the risk. How much money are you risking in the market today? And, especially today, here we are, it's March of 2022, and the market's very, very volatile. And what you would find with most people's portfolios is a very large amount of their money is at risk. It's in IRAs, 401ks, 403bs, 457s. Very little money in CDs and safety because the rates of return are just ridiculously low. So people are out there trying to get the best rate of return they can, but they're taking a lot of risk to do that. So the real question is, how much are you willing to risk? And the other thing is the closer you get to retirement, the less and less you're going to be wanting to risk if you really truly want to retire on the date that you want to retire on. Now, an example would be, let's just say we have $1 million in our total investable assets, and $50,000 of that's in our checking account, and $950,000 of that's over in our 401k, as an example. If the market loses 10%, then we just lost 9.5% of our entire portfolio, because only 50% of our money was at safety. But if we manage to get 50% of our money over into safety and the market loses 10%, then we only lost 5% of our total portfolio. I hope you can follow that. Now, if you go back to 2008 and you see where we lost up to 47% of our portfolios, if you had all your money in the market, that really hurt. And I know many, many people who ended up not retiring when they wanted to retire and having to work for 3 to 5 years more because they just didn't have enough money to retire on. So the closer you get to retirement, the less risk you should take. And the 5 years before you retire and the 5 years after you retire are some of the most important years when it comes to how much risk you take, because that's going to have a huge impact on whether your money lasts or not. Now, another factor that's going to come into play, and pretty much every time you hear me talk, I'm going to talk about, and that's taxation. It's the first thing you should consider when making an investment is the tax ramifications of your contributions, accumulation, and most importantly, distribution. Because see, you're playing a game. You're trying to accumulate as much money as you possibly can over here so that when you get to my world, which is distribution and preservation, you don't run out of money. It's a very, very important factor, and it's the one factor that scares most people when it comes to retirement is, will I run out of money in my lifetime? And a big factor on that is going to be taxation. And taxation, as you've heard me say before, if you've ever seen me, is the highest income taxes have ever been in the United States is 94%. And since the inception of the temporary income tax and the establishment of the IRS in 1913, the top marginal tax bracket was 94%, but the average was 57%. Currently, we're sitting at 37% with an outrageous national debt. And the bottom line here is that taxes only has one way to go, and that's up. So when we're looking at all this and safety and all that stuff with regards to retirement, we really want to be paying close attention to taxes. Now, let's get on real quickly here to indexing and talk about how indexing really works, because that was our main subject for the day. And I just want you to understand that people don't plan to fail. They fail to plan. And so when we're looking at this stuff, my only question to you is, what is your plan? How are you planning to make sure that you don't run out of money in your lifetime and don't get eaten up by the taxes? So let's talk a little bit about how indexing works. I made a spreadsheet here for you a long time ago that I find very beneficial to understanding how this works. So what happens with indexing is you need to understand that what they do is they do an annual point to point. So on your policy anniversary date, it's not a calendar anniversary. It's not January 1st to December 31st. It's whatever your policy anniversary date is. So we'll use the several different types of strategies that they use for indexing, and we'll explain each one of them so that you have a fairly good idea how this works. So let's use the S&P 500, and let's just say that the S&P 500 is at 1,000 on your policy anniversary date, which is 3/1 of 2022 or whatever date it is. And then 1 year later, when they measure that again, it's at 1,200. Well, the gain over that period of time was 16.67%. Now, if we had a cap strategy, meaning that the most we could make was the cap, which is 5%, then we would make 5%. Now, if we had a situation where, let's say it only went to 1,040, okay, well, that was a 3.85% gain. So we made 3.85%. So you see under column F here, we made 3.85, and over here, that was our cap, but over here is what the gain was. So going back once again to 1,200, we have a 16.67% gain in the market, but we only get 5. So we make everything to the cap and nothing beyond. Now, if we go to the spread strategy, which is column G over here, and let's just say that our spread is 1.75%, that means that we don't make the first 1.75%. Now, often people get very confused about this. Well, that's a fee. Well, no, it's actually not a fee. They're not going to reduce your account by that amount at the end of the year. They're going to take that and they're going to make sure that they eliminate that before they pay you the gains. So in the case here, where the gain was 16.67% with a 1.75% cap, they paid you 14.92%. All right. So if we were over here, though, you'd say, well, that's a much better gain than the cap strategy. Well, let's go back to where we put it at 1,030. Now we're making 2.91, but here we're only making 1.16% because 1.75 was reducing that amount because of the spread. Now, going back once again to 1,200, and we slide over here, we can see that when we're using a participation rate, then what that means is that if we have 100% participation, then we made all 16.67%. Now, it is possible to have a participation rate with a cap or a participation rate with a spread, but you'll just have to look at that and make sure that you understand it before you choose that option. Now, with regards to that, if we have a 50% participation rate, you can see we only made 8.33%. Now, all that said, let's go back over here and let's talk about why indexing is such a strong strategy. Well, you see, we started here at 1,000 and we ended at 1,200. Well, what if we ended at 800? That would be a 20% loss in the market or 25% loss in the market. And you can see here that when we lose that, we actually make zero. All the way across the board, we lose zero, we make zero. So at this point, zero is our hero. So whatever the gain is in the market, we're going to get whatever the strategy is. But anytime there's a loss in the market, we're not going to lose. We're always going to make zero when there's a loss in the market. Now, there are a couple other strategies. I'll explain one more, and that's the monthly point-to-point. And the monthly point-to-point is really quite incredible. I mean, if we sat over here and we looked at that, it could actually have some of the highest gains ever in the marketplace as far as indexing goes. However, don't get too excited about that because the reality is that it can also be very volatile and you end up with zero many, many times. So if every month of the year, the market was up here by 2%, then it was up by a total of 24, but it has a monthly cap of 1. Now, the interesting thing about this is it caps the ups, but it doesn't cap the downs. So you can see here we credited 12%, but if we just had a couple of bad months in here, like say minus 10% and a minus 5, and let's say this was up 10%, just as an example, or this one was up 15%. You can see here that even though the market was up 26% at the end of the year, we ended here at minus 5. And now, once again, we're going to credit 0 and we're going to make 0 because we have a negative number. Now, hopefully what that does is that helps you to understand a little bit about how indexing works and why indexing is such a powerful strategy. So once we've gone through all that stuff, let me just show you here how that works inside of a product, for example. So we started here back in the year 2000 with $100,000. And as you know, 2000, 2001, 2002, we had 3 bad down years. And as you can see on this chart here, we dropped down here and then it took us 5 years to get our head back up to even. All right. And then 2008 came along again. Took us another 5 years to get back up at even. And then if this chart went all the way out to 2022, what you'd see is that we ran all the way up for 13 years in the market. Well, the difference is by using indexing, we went sideways for that 3 years, and then we made some gains. We didn't make as much gains. You'll see that this line is much steeper than this line. And we went sideways in this period of time. We ended up at $352,000 by the end of 2017, and you and your brokerage account ended up at 181. So as you can see, the power of indexing is pretty strong. Now, if you look here, once again, here's the where it starts climbing again. It's level and it starts climbing again, and it goes on. Now, if you talk to this guy here, he says his number 1 rule is never lose money, and his number 2 rule is never forget number 1, never lose money. So the trick here is to not lose money. The trick is to remove the risk from your portfolio. So how does indexing work and what kind of products offer indexing? Well, you can use a maximum funded life insurance policy, which if you haven't gone and watched a show on that and understood how that actually works, you probably should, because it's not your grandfather's life insurance. It's going out and properly maximum funding life insurance policy under TEFRA, DEFRA, and TAMRA, the tax codes, allowing us to put as much money as we possibly can in an insurance policy, buying the least amount of insurance, getting most of the gains of the market, never participating in losses, and passing on 2 to 3 times that amount tax-free and accessing it tax-free throughout our lifetimes. In addition to that, we use indexed annuities, and all 3 of these things are going to provide us with those index choices inside of there. The choices will be different from company to company, and you want to be sure you get a good quality product that's going to suit your needs going forward. There is more money to be had by avoiding the losses than been trying to pick the winners. Now, I could spend, an hour sitting here and explaining to you how indexing works, but the most important thing to understand is that we're able to participate in some or most of the gains of the market, never participate in the losses. And what more do you want? I mean, when you get right down to it. Now, remember, when we're using a life insurance policy, we're always growing it tax-free. When we're using an annuity, we're always growing it tax-deferred. Or if it's a Roth IRA, we're always growing it tax-free. If we're using an annuity, we're also guaranteed to never run out of income, no matter how long we live. So be sure to subscribe to our YouTube channel below. Follow us on LinkedIn. And remember, live like you're going to die tomorrow and plan like you're going to live forever, because you just might. And don't forget, there's more money to be had by avoiding the losses than by trying to pick the winners. Keep smiling and make it a great day.